Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Hello and welcome. You are listening to the first chapter of our comprehensive guide on a topic that has become increasingly central to modern personal finance: how to choose the right investment application for your needs in the United States. In today's digital age, the world of investing is no longer confined to the high-rise buildings of Wall Street or exclusive brokerage firms. It's right here, in the palm of your hand, accessible through the sleek, powerful supercomputers we call smartphones. With just a few taps, you can buy a fraction of a share in a global tech giant, invest in a fund that tracks the entire market, or even explore alternative assets that were once reserved for only the wealthiest individuals. This is, without a doubt, a revolutionary shift. It represents the democratization of finance, a powerful movement that has empowered millions of Americans to take control of their financial futures in a way their parents and grandparents could only dream of. But with this incredible power comes a new and complex challenge: the paradox of choice. Open your phone's app store right now and search for investing. You will be met with a seemingly endless list of applications. Some will promise zero commission trades. Others will highlight their beautiful, user-friendly interfaces. You'll see apps that focus on automated, robo-advising, and others that give you the tools for complex, hands-on trading. Some are backed by century-old financial institutions, while others are disruptive startups aiming to change the game entirely. The sheer volume of options can be overwhelming, even paralyzing. How do you cut through the marketing jargon? How do you distinguish a genuinely valuable tool from a platform that might have hidden costs, or might not align with your personal financial goals? Choosing the wrong app can, at best, be an inconvenience. At worst, it could lead to unexpected fees, a poor investment strategy, or even a mismatch with your long-term aspirations, like saving for retirement or a down payment on a house. That is precisely why we have created this series. Our goal over the next 15 chapters is not to tell you which app to download. We will not be recommending one service over another. Instead, our purpose is to empower you with a clear, logical, and comprehensive framework. We will equip you with the knowledge and the right questions to ask, so you can confidently evaluate any investment app on your own terms and make a decision that is truly right for you. We will break this framework down into 5 fundamental pillars, 5 essential things you must look for when choosing your gateway to the investment world. Now, before we take another step forward, it is absolutely critical that we address a matter of utmost importance. This is, without question, the most vital part of our entire series. The information provided in this audio series is for educational and informational purposes only. It is not, and should not be construed as financial advice, investment advice, legal advice, or tax advice. We are not licensed financial advisors, certified public accountants, or attorneys. The world of finance is heavily regulated for a very good reason. Your financial situation is unique. Your income, your expenses, your debt, your risk tolerance, your family situation, and your life goals are specific to you. A strategy that works wonderfully for one person could be entirely inappropriate for another. Furthermore, laws, regulations, and tax codes are incredibly complex and are subject to change. Therefore, we strongly and unequivocally urge you to consult with qualified, licensed professionals before making any financial decisions. Speak with a certified financial planner or a registered investment advisor who can help you craft a personalized strategy. Consult with a certified public accountant or CPA to understand the tax implications of your investment choices. If you have complex estate or legal questions, you should seek the counsel of a qualified attorney. This series is designed to be a starting point for your research and a guide for your conversations with those experts. It is a tool to help you become a more informed investor, not a substitute for professional counsel. Your financial future is too important to leave to chance or to generic information. By continuing to listen, you acknowledge this disclaimer and agree that you are responsible for your own financial decisions. With that essential foundation laid, let's set the stage. Think back just a couple of decades. The process of investing for the average person was cumbersome. It often involved scheduling a meeting with a broker, making a phone call to place a trade, and paying significant commissions for each transaction. The minimum investment amounts were often high, creating a substantial barrier to entry for many people. Information was not as readily available. and the tools for analysis were often proprietary and expensive. The modern investment app has shattered those barriers. It has turned the old model on its head. Commissions have been driven down, in many cases to zero for certain types of trades. Fractional shares allow you to invest with just a few dollars, rather than needing hundreds or thousands to buy a single share of a high-priced stock. Information, from real-time stock quotes to company financial reports, is now available instantly and for free. This transformation is profoundly positive. It means more people than ever have the opportunity to build wealth over the long term by participating in the growth of the economy. However, it also means that the responsibility for making sound decisions falls more heavily on the individual. The app is just a tool. A powerful tool, yes, but a tool nonetheless. And like any tool, its effectiveness depends entirely on the person using it. A hammer in the hands of a skilled carpenter can build a beautiful home. In the hands of someone who doesn't know how to use it, it can cause a lot of damage. That is why a structured approach to choosing your app, your primary tool, is so critical. It's about looking past the flashy advertisements and the sign-up bonuses. It's about building a checklist for your own due diligence. Throughout this series, we will methodically build that checklist together, focusing on 5 core areas. We will start by dissecting the true cost of using an app, looking beyond the headline claim of commission-free, to uncover the other fees that can impact your returns. Then, we will dive into the non-negotiable elements of security and regulation, ensuring your money and your personal data are protected. After that, we will explore the vast universe of investment options, helping you understand which app offers the assets that align with your strategy, whether it's stocks, ETFs, mutual funds, or more. We'll then turn our attention to the user experience and the educational resources an app provides, because a good platform shouldn't just facilitate trades. It should help you become a more knowledgeable investor. Finally, we will examine the different account types and special features an app offers, from retirement accounts like IRAs to banking integration, ensuring the platform can grow with you over your financial journey. So consider this first chapter our foundational session. We've acknowledged the incredible opportunity that modern investment apps present. We've faced the challenge of overwhelming choice. And most importantly, we have established our commitment to an educational, responsible, and cautious approach. In our next chapter, we will begin our deep dive into the first, and for many, the most important pillar of our framework, understanding the true cost. We will explore the various types of fees, from trading commissions and expense ratios to transfer fees and payment for order flow, giving you the tools to accurately assess what you will truly be paying. Thank you for joining me. I look forward to guiding you through the next step of this journey. Welcome back. In our first chapter, we set the stage, exploring the new landscape of digital investing, and establishing the critical importance of approaching your financial journey with caution, and for educational purposes only. As a reminder, this series does not constitute financial, legal, or tax advice. Always consult with licensed professionals before making any investment decisions. Today, we begin our deep dive into the 5 pillars of choosing an investment app. We're starting with what is arguably the most tangible and impactful factor for your long-term returns: the true cost. Our focus for this chapter is to look beyond the flashy advertisements and understand every single type of fee or cost that can be associated with an investment app. Because in the world of investing, even seemingly small costs can have a massive impact over time due to the power of compounding. The most common marketing message you'll see today is commission-free trading. And it's true, the intense competition between brokerage apps has been a huge win for retail investors, largely eliminating the direct fee that was once charged for every single stock or ETF trade you made. In the past, you might have paid $5, $10, or even $20 just to buy or sell a security. The elimination of these commissions is a significant step forward. However, it is a dangerous mistake to assume that commission-free means cost-free. The companies that run these apps are businesses, and like any business, they need to generate revenue. That revenue has to come from somewhere. Understanding their business model is the first step to becoming a savvy consumer of their services. So let's break down the various types of costs you need to investigate, starting with the most visible and moving to the more hidden ones. First, let's talk about trading fees. While many apps offer zero commission trades for common US stocks and exchange-traded funds, or ETFs, this policy doesn't always apply to everything. You must read the fine print. For instance, some platforms may still charge commissions for trading mutual funds. Others might charge a fee for trading over-the-counter, or OTC stocks, which are often called penny stocks. If you plan to invest in international stocks, there might be foreign exchange fees or higher commissions involved. Options trading is another area. While the base commission might be zero, there is almost always a per-contract fee, typically ranging from 50 cents to $1 per contract, which can add up quickly for active traders. So the first question to ask is, what exactly is commission-free, and what is not? Next, we need to discuss one of the most important, yet often overlooked costs, the expense ratio. This is not a fee charged by your brokerage app itself, but rather by the company that manages a mutual fund or an ETF. The expense ratio is an annual fee, expressed as a percentage, that covers the fund's operating costs, including portfolio management, administration, and marketing. This fee is deducted directly from the fund's assets, so you won't see it as a separate charge on your account statement. Instead, it directly reduces your investment return. Let's imagine you invest $10,000 into a mutual fund with a 1% expense ratio. Over the course of a year, $100 will be deducted from your investment to cover the fund's costs. Now imagine another similar fund that has an expense ratio of just 0.1%. The annual cost for that fund would be only $10. While $90 a year might not sound like a life-changing amount, over an investing lifetime of 30 or 40 years, the difference can be staggering. Tens or even hundreds of thousands of dollars less in your pocket due to the higher fee, all thanks to the effect of compound growth. When you evaluate an app, check if it gives you easy access to view the expense ratio for any fund you're considering. Low-cost index funds and ETFs are a popular choice for many investors precisely because their expense ratios are often incredibly low. Now, let's venture into the more subtle costs. Many apps that offer commission-free trading make a significant portion of their money through a practice called payment for order flow, or PFOF. This is a complex topic, but the basic concept is this. When you place a trade on your app, the app doesn't always send your order directly to a major stock exchange like the New York Stock Exchange. Instead, it routes your order to a large third-party trading firm, often called a market maker or a wholesaler. These market makers then pay your brokerage app a small fee, perhaps fractions of a penny per share, for the right to execute your trade. The argument in favor of this practice is that it allows brokerage apps to eliminate commissions for you, the end user. However, critics raise concerns about a potential conflict of interest. Your broker has a legal obligation to seek the best execution for your trades. But if they are being paid by one market maker, are they incentivized to route your order to whoever pays them the most, rather than to the one who can get you the absolute best price? The difference in the price you get, called price improvement, might be tiny, just a fraction of a cent per share. But for market makers processing millions of trades, and for you over a lifetime of investing, these tiny fractions can add up. Some brokerage apps have built their brand on refusing to accept payment for order flow, instead charging a small commission. This is a philosophical and practical trade-off you must consider. Does the benefit of a zero-commission trade outweigh the potential for a less-than-optimal execution price? There is no single right answer, but it's a critical aspect of an app's business model to understand. Beyond trading, we have account fees. While many modern apps have eliminated these, some traditional brokerages may still charge them. Look out for annual account maintenance fees, which are flat fees just for having an account. Some may charge inactivity fees if you don't make a certain number of trades over a period of time. There are also fees for specific services. For example, if you want to transfer your entire account from one brokerage to another, you will almost certainly be charged an account transfer fee, which can be $75 or more. There can also be fees for things like wire transfers, requesting paper statements, or closing an account. Before you sign up, find the app's fee schedule. It's usually a document linked at the bottom of their website, and read it carefully. Finally, if you plan on using more advanced features, look for the margin interest rate. Margin allows you to borrow money from your broker to purchase securities. This can amplify your gains, but it can also dramatically amplify your losses. The interest rate you pay on borrowed funds is a direct cost to you. These rates can vary significantly between apps, so if using margin is part of your strategy, comparing these rates is essential. So to recap, when you investigate the true cost of an investment app, you are looking far beyond the commission-free sticker. You need a checklist. 1. What are the commissions on assets beyond U.S. stocks and ETFs such as options, mutual funds, or international securities? 2. How easily can I find and compare the expense ratios for the funds I want to invest in? 3. What is the company's policy on payment for order flow, and how does it affect my trade execution? 4. What are the account-related fees such as maintenance, inactivity, or transfer fees? And 5. If applicable, what is the margin interest rate? Finding these answers requires a little bit of detective work. Look for a pricing or fees page on the app's website. Download their full fee schedule. Read their disclosures. This process might seem tedious, but understanding the cost structure is a fundamental act of due diligence. It ensures there are no surprises, and that more of your hard-earned money stays invested and working for you. In our next chapter, we will move from the costs you can see to the protections you can't, the critical pillar of security and regulation. We'll discuss how to ensure your chosen platform is properly regulated and that your money is safe. Welcome back to our ongoing guide for evaluating U.S. investment apps. In the last chapter, we peeled back the layers of the fee structures that underpin these powerful financial tools. Today, we shift our focus from the cost of investing to something even more fundamental: the safety and security of your money and your personal information. This is a topic with no room for compromise. When you deposit money into an investment app, you are placing an immense amount of trust in that company. You trust them to hold your funds, execute your trades accurately, and most importantly, protect your assets from theft, fraud, and institutional failure. So, how can you verify that an app is worthy of that trust? The answer lies in understanding the overlapping frameworks of government regulation, industry insurance, and digital security. Let's begin with the highest level: government and industry regulation. In the United States, the securities industry is not a Wild West. It is a highly regulated environment designed to protect investors. Two of the most important organizations you need to know about are the SEC and FINRA. The SEC, which stands for the Securities and Exchange Commission, is an independent agency of the United States federal government. Its primary mission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. The SEC creates and enforces the foundational rules that all market participants, including brokerage firms that create investment apps, must follow. Working under the SEC's oversight is FINRA, the Financial Industry Regulatory Authority. FINRA is a non-governmental, self-regulatory organization that writes and enforces the rules governing the activities of all registered brokerage firms and their brokers in the U.S. Think of FINRA as the frontline regulator for the brokerage industry. They conduct regular examinations of firms to ensure they are complying with the rules, and they manage the licensing and testing for financial professionals. So the first and most basic check you must perform is to ensure that the brokerage firm behind the investment app is a member of FINRA and registered with the SEC. Any legitimate brokerage operating in the United States will be. You can verify this for yourself using a free tool provided by FINRA called BrokerCheck. Simply go to the FINRA website and use the BrokerCheck tool to search for the name of the brokerage firm. The results will show you their registration status, their history, and any regulatory actions or disciplinary issues they may have had. If you cannot find the firm on BrokerCheck, that is a major red flag, and you should not proceed. Next, let's talk about investor insurance. This is a critical safety net. You've likely seen the letters FDIC at your local bank, which insures your bank deposits. The equivalent for the investment world is SIPC, which stands for the Securities Investor Protection Corporation. It is vital to understand what SIPC does and does not do. SIPC is not the same as FDIC insurance. It does not protect you against market losses. If you buy a stock and its value goes down, that is an investment risk, and SIPC provides no protection for that. The purpose of SIPC is to protect the assets in your account if your brokerage firm fails financially, for example, if it goes bankrupt. If a SIPC member brokerage firm were to fail and customer assets were missing, SIPC steps in to restore those assets to customers. As of now, SIPC protection covers up to $500,000 in total assets per customer, which includes a $250,000 limit for cash held in the account. This protection applies to the securities in your account, like stocks, bonds, ETFs, and mutual funds, as well as the cash held for the purpose of purchasing securities. Almost every legitimate brokerage firm in the U.S. is a member of SIPC. You should see the SIPC logo displayed on the app's website, typically in the footer. If you are ever in doubt, you can confirm a firm's membership on the SIPC website. Choosing an app that is not SIPC insured is an unnecessary risk that you should not take. Now let's move from institutional safety to digital security. In an age of sophisticated cyber threats, the technological safeguards an app employs are just as important as its regulatory standing. A secure app protects your account from unauthorized access. There are several key features you should look for. The absolute baseline for security today is two-factor authentication, often abbreviated as 2FA. This means that to log into your account, you need more than just your password. You need a second piece of information, a second factor. to prove it's really you. This second factor is typically something you have, like your phone. It could be a code sent via text message, or more securely, a code generated by an authenticator app, or even a push notification that you approve. You should also check if the app supports biometric authentication, such as using your fingerprint or Face ID to log in. Always enable 2FA on your financial accounts. It is one of the most effective ways to prevent your account from being compromised. The next critical feature is data encryption. When your data is sent from your phone to the app servers, and when it is stored on those servers, it must be encrypted. This process scrambles your information into an unreadable code that can only be deciphered with a specific key. Look for mentions of banking-grade or military-grade encryption, such as AES 256, Advanced Encryption Standard with 256-bit keys, and SSL/TLS, Secure Sockets Layer/Transport Layer Security, for data in transit. While you won't see the encryption working, the company should state its commitment to these security standards in its security policy or frequently asked questions. Finally, a good app will provide you with account alerts and notifications. You should have the ability to set up alerts for logins from new devices, trades being placed, or money being transferred. These real-time notifications can act as an early warning system, allowing you to react quickly if you ever spot suspicious activity on your account. In summary, safeguarding your assets involves a three-pronged investigation. First, check the regulation. Is the firm registered with the SEC and a member of FINRA? Use the broker check tool to verify. Second, check the insurance. Is the firm a member of SIPC, offering protection for your securities and cash in the event of firm failure? And third, check the digital security. Does the app offer robust security features, most importantly two-factor authentication, strong data encryption, and account activity alerts? These are not optional features. They are essential pillars of trust. Taking the time to verify them is a fundamental step in protecting your financial future. In our next chapter, we will transition from safety and costs to the investments themselves. We'll explore the third pillar, investment options and asset classes, to help you determine if an app offers the right tools for your specific investment goals. Hello and welcome back. In our journey so far, we have built a crucial foundation. We've tackled the importance of a guiding framework, dissected the true costs of investing, and emphasized the non-negotiable elements of security and regulation. Now we arrive at the third pillar, which is the heart of what these apps allow you to do: access the investments themselves. This chapter is dedicated to exploring the different investment options and asset classes available to you. Before we proceed, please remember the essential condition of this series. The following information is for educational purposes only and is not investment advice. Your personal financial goals and risk tolerance are unique, and you should always consult with a qualified financial advisor to develop a strategy that is appropriate for your individual circumstances. Think of an investment app as a toolbox. A basic toolbox might only have a hammer and a screwdriver, while a professional one has a vast array of specialized instruments. Similarly, different investment apps offer different tool sets. The key is to find an app whose toolbox contains the specific instruments you need to build your financial future. Let's open up this toolbox and examine the most common instruments you will find. The most well-known investment is the individual stock. When you buy a share of stock in a company, like Apple or Ford, you are purchasing a small piece of ownership in that business. If the company performs well and its value increases, the price of your stock may go up. If it performs poorly, the price may go down. Stocks are often categorized by company size or market capitalization. You'll hear terms like large cap, mid cap, and small cap stocks, referring to large, medium, and smaller companies respectively. Investing in individual stocks gives you direct ownership, but it also means your success is tied to the fortunes of that single company, which represents a higher concentration of risk. A revolutionary feature offered by most modern apps is the ability to buy fractional shares. In the past, if a single share of a company's stock cost $1,000, you needed at least $1,000 to invest. Fractional shares shatter this barrier. They allow you to invest by dollar amount rather than by share count. So if you only have $50, you can buy a fraction, in this case 5%, of that $1,000 share. This feature is incredibly powerful for new investors, and for those who want to build a diversified portfolio of many different stocks without needing a large amount of capital. When evaluating an app, check if it offers fractional shares, and if there are any limitations on which stocks are eligible. Next, we have one of the most popular investment vehicles today, the Exchange-Traded Fund, or ETF. An ETF is a bundle of investments. It can hold hundreds or even thousands of stocks or bonds. that trades as a single security on an exchange, just like a stock. ETFs offer instant diversification. For example, instead of trying to pick the single best technology company, you could buy a technology-focused ETF that holds shares in dozens of different tech companies. The most common type of ETF is an index fund ETF. These funds are designed to passively track a specific market index, such as the S&P 500, which represents 500 of the largest U.S. companies. By buying a single share of an S&P 500 ETF, you gain exposure to the performance of all 500 of those companies. ETFs are not limited to broad markets. You can find them for specific sectors of the economy, like healthcare or energy, for international stocks, for different types of bonds, and even for commodities like gold. Because most are passively managed, they typically have very low expense ratios, which, as we learned in Chapter 2, is a significant advantage for long-term investors. Similar to ETFs are mutual funds. Like an ETF, a mutual fund is a professionally managed portfolio that pools money from many investors to purchase a collection of securities. However, they differ in a few key ways. Mutual funds are typically priced only once per day, after the market closes, whereas ETFs trade throughout the day like stocks. Many mutual funds are actively managed, meaning a fund manager or a team of analysts is actively trying to outperform the market by picking what they believe will be winning investments. This active management usually results in higher expense ratios compared to passive ETFs. Some apps specialize in offering a wide variety of mutual funds, while others may offer a limited selection or none at all. Another primary asset class you'll encounter is bonds. When you buy a bond, you are essentially lending money to an entity, which could be a corporation, a corporate bond, or a government, like a U.S. Treasury bond. In return for your loan, the issuer promises to pay you periodic interest payments over a set term, and then to return your principal amount at the end of that term. Generally speaking, bonds are considered to be a less volatile asset class than stocks. They are often used in portfolios to provide a stream of income, and to balance the higher risk of stocks. Many investment apps allow you to invest in bonds not by buying them individually, but through bond ETFs or bond mutual funds, which hold a diverse basket of different bonds. Finally, some apps may offer what are considered alternative investments. This is a broad category that can include real estate investment trusts or REITs, which allow you to invest in a portfolio of real estate properties. It can also include commodities like precious metals. And in recent years, many apps have added the ability to buy and sell cryptocurrencies like Bitcoin and Ethereum. It is important to recognize that these types of assets often carry different, and in many cases significantly higher, risk profiles and regulatory considerations than traditional stocks and bonds. So when choosing an app, you must ask yourself, what do I want to invest in, both now and in the future? A person whose strategy is to simply invest in a few low-cost, broad-market ETFs has very different needs from an active trader who wants to research and pick individual stocks, or someone who wants to allocate a small portion of their portfolio to alternative assets. Look at the app's list of available investments. Is it broad enough for your needs? Does it provide access to the specific ETFs, mutual funds, or stocks you've researched? Making sure the toolbox fits the job is a critical step in making the right choice. In our next chapter, we will explore the fourth pillar, user experience and educational resources. We will discuss why the design of the app and the learning tools it provides can be just as important as the investments it offers. Hello and welcome back. Thus far in our series, we've established a robust checklist for the technical and financial aspects of choosing an investment app. We've examined costs, confirmed the importance of security and regulation, and surveyed the landscape of available investment options. Now we turn to the fourth pillar, a more subjective but equally crucial area, the user experience and the educational resources the app provides. As always, we begin with our essential reminder. This content is for educational and informational purposes only. It is not a substitute for professional financial, legal, or tax advice. Please consult with qualified experts to address your personal financial situation. The user experience, often called UX, is about how an app feels to use. Is it simple and intuitive? Or is it confusing and cluttered? This isn't just a matter of aesthetics. For a financial app, a good user experience can be the difference between making a confident, informed decision and making a costly mistake. A poorly designed app can lead to confusion, frustration, and even errors, like accidentally buying the wrong security or misunderstanding your own portfolio's performance. Let's break down what a good user experience looks like in this context. The first element is clarity and simplicity. When you open the app, Your primary information should be front and center. How much money is in your account?
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
What is your portfolio's overall value? How has it performed today? These key data points should be instantly accessible without having to navigate through multiple confusing menus. The language used should be plain English, avoiding excessive industry jargon wherever possible. The goal is to feel empowered, not overwhelmed. Next is intuitive navigation. You should be able to move through the app's core functions, like searching for a stock, placing a trade, or transferring funds, with a logical flow. The buttons should be clearly labeled, and the process for executing an action should be straightforward. Consider the process of placing a trade. A well-designed app will walk you through the steps clearly. Choosing the asset, specifying the amount in dollars or shares, and confirming all the details on a final review screen before you commit. This final review screen is critical. It's a safety check that helps prevent errors. If an app's interface feels clunky or you find yourself frequently getting lost, it can add unnecessary stress to your investment process. Another key component of the user experience is data visualization. Investing involves a lot of numbers, and raw numbers can be difficult to interpret. Good apps use clean, easy-to-read charts and graphs to help you visualize information. This could be a simple line chart showing your portfolio's growth over time, or a pie chart that breaks down your holdings by asset type or industry sector. When you look up a specific stock, the app should present its historical price performance in a clear chart that you can adjust for different time frames. The ability to see your financial story visually can provide powerful insights that a simple list of numbers cannot. Beyond the app's design, the second half of this pillar is the suite of educational resources it offers. A top-tier investment app doesn't just see itself as a transaction platform. It sees itself as a partner in your financial education. This is especially important if you are just beginning your investment journey. The best platforms for beginners recognize that an informed investor is a better long-term customer. Look for a dedicated Learn or Education section within the app or on its website. What kind of content do they provide? High-quality educational hubs often include a glossary of financial terms. If you don't know the difference between a market order and a limit order, or what an expense ratio is, a good app will provide simple, clear definitions. They may also offer a library of articles or short lessons on foundational investing concepts. These can range from introductory topics like what is a stock, or the importance of diversification, to more intermediate concepts like how to read a company's earnings report. This content should be objective and educational, not promotional. Its goal should be to teach you investing principles, not to push you into buying a specific product. Some platforms go even further, providing market news, analysis, and data. They might integrate news feeds from reputable financial sources, provide access to analyst ratings on stocks, or offer basic company financial data like revenue and earnings. This information can serve as a valuable starting point for your own research. It allows you to stay informed about market trends and to dig deeper into the companies you're considering for investment. Finally, consider the platform's approach to communication. Does the app provide clear explanations for why a trade might have been rejected? Are its account statements and tax documents easy to find and understand? When you need help, is customer service accessible? While not strictly an educational resource, this level of clarity and support is part of the overall experience that helps you feel confident and in control. In essence, this pillar is about evaluating the app as your co-pilot. Does it make your journey smoother and help you understand the terrain? Or does it complicate things and leave you to navigate on your own? The technical ability to place a trade is the bare minimum. A truly great platform will also provide a clean, stress-free interface and the resources you need to grow your knowledge over time. In our next chapter, we will address the fifth and final pillar of our framework: account types and special features. We'll explore how to ensure the app you choose can accommodate your evolving financial goals, from retirement planning to managing your cash. Hello and welcome back. We have now arrived at the fifth and final pillar in our framework for choosing a U.S. investment app: account types and special features. We've analyzed costs, verified security, surveyed investment options, and weighed the importance of the user experience. This final piece of the puzzle is about ensuring the platform is versatile enough to grow with you and support your specific, long-term financial goals. As we must emphasize in every chapter, this guide is for educational and informational purposes only. It is not financial, tax, or legal advice. The world of financial accounts, especially those with tax implications, is complex. It is essential to consult with a qualified financial advisor and a tax professional to determine the best course of action for your personal situation. The first and most fundamental choice you will make is the type of account you open. The most common option is a standard individual brokerage account, which is also often called a taxable brokerage account. This is the most flexible type of investment account. There are no limits on how much you can contribute, and you can withdraw your money at any time for any reason without penalty from the government. However, as the name implies, it is taxable. This means that when you earn money from your investments, either through dividends or by selling an investment for a profit, which is known as a capital gain, that income may be subject to taxes in the year it is realized. These accounts are excellent for general-purpose investing goals that fall outside of retirement, such as saving for a down payment on a house, a new car, or simply building wealth over the medium to long term. The other major category of accounts is specifically designed for retirement savings. These are individual retirement arrangements, or IRAs. IRAs offer powerful tax advantages to incentivize people to save for the long term. There are two primary types you'll encounter on most investment apps: the traditional IRA and the Roth IRA. A traditional IRA offers a potential tax deduction on your contributions today. Depending on your income and whether you have a retirement plan at work, the money you contribute may be deductible from your taxable income for the year, which could lower your tax bill in the present. Your investments then grow tax-deferred, meaning you don't pay taxes on gains or dividends year after year. Taxes are paid in the future, when you withdraw the money in retirement, at which point the withdrawals are treated as ordinary income. A Roth IRA works in the opposite way. Your contributions are made with after-tax dollars, meaning you get no upfront tax deduction. However, the true power of the Roth IRA is that your investments grow completely tax-free. And provided you follow the rules, your qualified withdrawals in retirement are also 100% tax-free. Both types of IRAs have annual contribution limits set by the government, and there are rules and potential penalties for withdrawing money before you reach retirement age, which is currently 59 and a half. The choice between a traditional and a Roth IRA involves many factors, including your current income, your expected future income, and your overall tax strategy. This is a critical conversation to have with a tax professional. When choosing an investment app, you must verify that it offers the type of IRA you plan to use. Beyond these core account types, some platforms are evolving into more comprehensive financial hubs. They may offer a cash management account. This is typically an account held at the brokerage that functions much like a checking or savings account. It might come with a debit card, the ability to direct deposit your paycheck, and FDIC insurance on your cash balance, often through a network of partner banks. This can be a convenient feature, allowing you to hold your investment portfolio and your day-to-day cash in one place, making it seamless to move money between spending and investing. After you've confirmed the app supports the account types you need, the final step is to look at the special features that can enhance your investing process. One of the most valuable features for long-term investors is the option for automatic, recurring investments. This allows you to set up a schedule to automatically transfer a set amount of money from your bank account and invest it into your chosen securities, for example, $50 every Friday. This automates the habit of consistent saving and investing, which is a cornerstone of building wealth over time. It also facilitates a strategy known as dollar-cost averaging, where you invest a fixed amount regularly, regardless of the market's ups and downs. Another powerful feature to look for is a dividend reinvestment plan, commonly known as a DRIP. If you own stocks or funds that pay dividends, a DRIP automatically uses that dividend cash to purchase more shares of the same security, often in fractional amounts. This creates a compounding effect, as your new shares may then generate their own dividends. Enabling a DRIP is a simple set-it-and-forget-it way to accelerate the growth of your investments. For those who are more hands-on with their research, check if the app provides a stock screener. A stock screener is a tool that allows you to filter the entire universe of stocks based on criteria you set. For example, you could screen for companies in a specific industry, with a certain market capitalization, or that have shown a particular level of revenue growth. It's a powerful way to narrow down thousands of options into a manageable list for further research. This brings us to the end of our 5-pillar framework. We've journeyed from understanding costs and security, to surveying investment options and the user experience, and finally, to aligning the platform's account types and features with your personal goals. You are now equipped with a comprehensive checklist. In the chapters that follow, we will move from theory to practice. We'll walk through how to apply this framework, discuss common beginner mistakes to avoid, and explore the psychological aspects of being a long-term investor. Hello and welcome back. Over the last several chapters, we have methodically constructed a 5-pillar framework for the technical evaluation of an investment app. We've covered costs, security, investment options, user experience, and account types. You now have a powerful checklist to analyze the tools. But as any experienced craftsman will tell you, the tool is only half the equation. The other half is the mindset of the person using it. Today we pivot from the external to the internal. We will explore the psychological aspects of investing, the common mental hurdles and emotional reactions that every investor, from the novice to the seasoned professional, must learn to manage. This chapter is about developing a resilient, long-term investor's mindset. As we always do, we must begin with our foundational reminder. This content is for educational purposes only. It is not financial advice. The psychological and emotional aspects of investing are deeply personal. The concepts discussed here are meant to provide context and awareness, not to serve as a guide for your personal decisions. Always consult with a qualified financial professional who can provide guidance tailored to you. One of the first psychological challenges many new investors face is analysis paralysis. You've done your research. You've compared a few apps using the framework we've discussed. You've even funded your account. But when it comes time to make that very first investment, you freeze. The sheer volume of choices, the endless stream of financial news, and the fear of making the wrong choice can be completely overwhelming. You find yourself researching endlessly, reading one more article, or watching one more video, but never actually taking action. The result is that your money sits in cash, and you miss out on potential growth. Recognizing this state of being overwhelmed by information is the first step to overcoming it. Often, the remedy is to simplify, to start small, and to focus on the foundational principles you have already learned. Once you begin investing, you will inevitably encounter two of the most powerful and dangerous emotions in finance: fear and greed. These two forces drive market cycles and can derail even the most well-intentioned investor. Greed often manifests as FOMO, or the fear of missing out. You see a particular stock or cryptocurrency soaring in value. You read stories online or hear from friends about the incredible returns they are making. An intense feeling builds that if you don't jump in right now, you will miss out on a life-changing opportunity. This feeling can compel you to abandon your own research and strategy, and instead, chase a hot investment, often buying in at the peak of its hype. This type of emotionally driven decision-making is a form of gambling, not investing, and it rarely ends well. A disciplined investor understands that there will always be another opportunity, and that it's more important to stick to a rational, well-researched plan. The opposite of greed is fear, and its most potent form in investing is panic selling. The market will not always go up. There will be days, weeks, or even months when your portfolio's value declines. This is a normal and expected part of investing. During these downturns, it is a natural human instinct to feel fear. Your brain is wired to avoid pain, and seeing your account balance drop feels painful. Panic selling is the act of selling your investments in the middle of a market downturn, driven by the fear that they will fall even further. The problem is that this action locks in your losses and often causes you to miss the subsequent recovery. Historically, markets have always recovered from downturns over the long term. One of the single greatest determinants of long-term investment success is the ability to remain calm and stick to your plan during periods of market volatility. These emotional responses are fueled by a series of behavioral biases, mental shortcuts our brains use that can lead to irrational decisions. One is confirmation bias, the tendency to seek out and favor information that confirms our existing beliefs. If you are excited about a particular stock, you might subconsciously ignore negative news about it and only pay attention to the positive articles, creating a dangerous echo chamber for your decision. Another is recency bias, where we give too much weight to recent events. If the market has been going up for the last year, we start to believe it will go up forever. If it just had a bad week, we become convinced a crash is imminent. This short-term focus can blind us to the much more important long-term trends. So, how does one build a mindset to navigate these challenges? It begins with establishing a clear why. Why are you investing? Is it for retirement in 30 years? A house in 7 years? Your goals provide an anchor. When the short-term waves of market news and emotion are crashing around you, your long-term goals are the lighthouse that keeps you focused on your destination. It also involves embracing the concept of time in the market, not timing the market. Countless studies have shown that trying to guess the market's peaks and valleys, selling at the top and buying at the bottom, is a fool's errand. A more reliable path for many is to invest consistently over a long period and allow the power of compounding to work, riding out the inevitable volatility along the way. Developing this mindset is a skill that takes time and practice. It is about shifting your perspective from the daily noise of the market to the long-term signal of economic growth. Your investment app is your tool, but your own discipline, patience, and emotional awareness are your greatest assets. In our next chapter, we will discuss some common mistakes that beginners make when they first start using these apps, and how an awareness of these pitfalls can help you avoid them. Hello and welcome back. Over the past 8 chapters, we have established a comprehensive 5-pillar framework and explored the psychological mindset and common pitfalls associated with investing. We've covered a great deal of theory. Now it's time to put it into practice. In this chapter, we will walk through a hypothetical simulation of how you might apply this framework to research an imaginary investment app. Before we begin this practical exercise, our essential disclaimer remains paramount. This is a fictional simulation for educational purposes only. It is not financial advice. We are not evaluating a real app, and the process shown is designed to illustrate a method of inquiry, not to recommend a specific outcome. You must conduct your own thorough research and consult with qualified financial and tax professionals before making any decisions. Let's imagine you've just heard about a new, popular investment app. We'll call it Apex Invest. It has a slick marketing campaign, and your friend mentioned that they use it. Instead of just downloading it and depositing money, you decide to put it through our 5-pillar test. You grab a notepad or open a new document, and you begin your investigation. Pillar 1. Uncovering the true cost. Your first step is to look past the headline "Zero Commission Trading." You go to the Apex Invest website, not just the App Store page, and look for a link in the footer of the page that says pricing, commissions, or fee schedule. You find it and click. Your first question is, what isn't free? You scan the document for any mention of fees for trading mutual funds, options contracts, or over-the-counter stocks. You see that options have a 65-cent per contract fee, which is a key piece of data if you ever plan to trade options. You also note that wire transfers have a fee, and transferring your account out to another brokerage will cost $75. You make a note of this. Next, you look for information on their business model. You use the search function on their site to look for payment for order flow, or PFOF. You find a disclosure page that explains that Apex Invest, like many brokers, does accept PFOF. You make a note of this, understanding the trade-off between zero commissions and potential execution quality that we discussed in Chapter 2. Finally, while you are on the website, you search for a popular S&P 500 ETF and see if the expense ratio is clearly displayed. Apex Invest shows it right on the assets page. Your cost analysis is now much more complete than just commission-free. Pillar 2. Verifying security and regulation. This pillar is about verification, not just taking the company's word for it. On the Apex Invest website, you see the SIPC logo in the footer. That's a good sign. But you go a step further. You open a new browser tab and navigate to the official SIPC website, and use their member directory to confirm that Apex Invest Financial LLC is indeed a member. It is. Next, you want to check their regulatory standing. You navigate to FINRA's official broker check tool. You type in the firm's full legal name. The search results pop up, confirming that they are registered with the SEC and are a member of FINRA. You also take a moment to scan the firm's history for any major red flags or disciplinary actions. Finally, you investigate their digital security features. You find their security page, where they mention using 256-bit encryption. Most importantly, you search their help center for two-factor authentication, or 2FA. You find an article that confirms they support 2FA through authenticator apps, which is a strong security standard. You now have confidence that the app meets the industry standards for safety. Pillar 3. Exploring investment options. Now you need to see if the app's toolbox fits your potential needs. Your primary interest is in long-term investing using low-cost ETFs and some individual stocks. You browse the section of their website that lists available investments. You confirm they offer a wide range of US stocks and ETFs, and that they support fractional shares, which is important to you. You also have a secondary interest in potentially investing in international stocks in the future. You search their site and find that, at this time, Apex Invest only offers access to US-listed securities. They do not currently support direct trading on international exchanges. This is a crucial finding. It doesn't mean the app is bad, but it means there is a limitation you need to be aware of. You make a note. Good for US investments, but may need another solution for international stocks later. Pillar 4. Evaluating the user experience and educational resources. This is a more subjective pillar. To get a feel for the app, you watch a few video reviews on YouTube from independent creators to see the interface in action. It looks clean and simple to navigate. You also visit the Apex Invest website and find their Learn section. You see a library of well-written articles explaining basic concepts like diversification and compound interest. They also have a glossary of financial terms. This tells you that the company has invested in investor education, which you see as a positive sign. The overall impression is that the app is designed to be user-friendly for someone with your level of experience. Pillar 5. Checking account types and features. Finally, you need to ensure the app can support your goals. Your primary goal is to start investing for retirement. Therefore, you need the app to offer IRA accounts. You search the site for IRA and find a page detailing that Apex Invest offers both traditional and Roth IRA accounts. This is a critical green light. You also look for features that promote good habits. You confirm the app supports automatic, recurring investments, allowing you to set up a consistent investment schedule. You also verify that they offer a dividend reinvestment plan (DRIP). You see no mention of a sophisticated stock screener, but given your initial focus on ETFs, this isn't a major drawback for you at this stage. After about an hour of this focused research, your notepad is full of objective data points, not just marketing claims. You have a clear picture of Apex Invest's strengths and weaknesses, as they relate to your specific needs. You have successfully moved from being a passive consumer to an informed evaluator. This is the power of the framework. In our next chapter, we will delve into the practical steps of opening and funding your account, and what to expect in those first few days as a new investor. Hello and welcome back. In our last chapter, we conducted a research simulation, applying our 5-pillar framework to a hypothetical investment app. We moved from theory to a practical research method. Today, we're taking the next logical step. This chapter will walk you through the general process of actually opening an account, funding it with your initial investment, and navigating those first few crucial days. As we venture into these action-oriented steps, our guiding principle remains as important as ever. This is for educational and informational purposes only. This is not advice or a recommendation to open any particular account. The process can vary slightly between institutions, and you are solely responsible for your own financial decisions. Always ensure you have consulted with the appropriate qualified professionals regarding your personal situation. Let's assume you have completed your research. You have used the 5-pillar framework to evaluate several options, and have selected an app that you believe aligns with your needs and goals. The first step is the account application process. For most modern apps, this is a straightforward, digital process that you can complete on your phone or computer in about 15 minutes. You will be asked to provide key personal information, which is required by federal law, including the USA Patriot Act and Know Your Customer rules designed to prevent fraud and money laundering. You should be prepared to provide your full legal name, your residential address, your date of birth, and your social security number or taxpayer identification number. You will also need a government-issued photo ID, such as a driver's license or passport, and you may be asked to upload a picture of it. Next, you will likely be asked a series of questions about your financial situation. These are known as suitability questions. You'll be asked about your employment status, your approximate annual income, and your estimated net worth. You will also be asked to define your investment objective, for example, capital preservation, income, growth, or speculation, and your risk tolerance, often on a scale from low to high. It is important to answer these questions honestly. They are used by the brokerage firm to comply with FINRA regulations that aim to ensure that any investment recommendations or features offered to you are suitable for your financial profile. During this process, you'll also officially select your account type. For instance, an individual brokerage account or a Roth IRA. You will be presented with customer agreements and terms of service. While it can be tempting to simply scroll to the bottom and click, "I agree," it is a good practice to take some time to review these documents, as they form the legal contract between you and the brokerage firm. Once your application is submitted, there is usually a short verification period, which can range from being nearly instant to a few business days. After your account is approved, the next step is to fund the account. This means transferring money into your new brokerage account so you can begin investing. The most common method for this is an ACH transfer from a linked bank account. ACH stands for Automated Clearinghouse, and it's the same network used for things like direct deposit and automatic bill payments. To set this up, you'll need your bank's routing number and your account number. ACH transfers are typically free, but they can take a few business days, often 3 to 5, for the funds to be transferred and fully settled or cleared for investing. A faster, though usually more expensive, option is a wire transfer. Wire transfers are direct bank-to-bank transfers that can often be completed within the same business day. However, your bank will likely charge a fee for sending a wire, often between $20 and $30 for a domestic transfer. This method is typically used for larger, more time-sensitive deposits. Some apps also still support funding by mailing a physical check. Let's say you've initiated an ACH transfer. Now comes a short but important waiting period. When the money first appears in your investment account, it may be listed as unsettled funds, or cash available to trade, while the cash available to withdraw might still be zero. This is normal. It means the transfer is in process but not yet finalized. Once the funds are fully settled, you are ready to make your first investment. Those first few days are a great time to simply familiarize yourself with the app's dashboard. Don't feel rushed to invest immediately. Take the time to navigate the interface. Find your account value, your cash balance, and your portfolio holdings, which will be empty at first. Practice using the search function to look up stocks or ETFs you researched. Find the trade button and walk through the steps of the order entry screen without actually placing a trade. This will build your confidence and help ensure you don't make an accidental error when you are ready to invest. This initial phase, the application, the funding, and the familiarization, is a deliberate and important process. It marks your official transition from a researcher to an investor. In our next chapter, we will discuss the mechanics of placing your very first trade, demystifying concepts like market orders, limit orders, and the bid-ask spread. Hello and welcome back. In our previous chapter, we walked through the general steps of opening and funding your brokerage account. Your account is now active, the funds have settled, and you have familiarized yourself with the app's interface. Now you've arrived at a major milestone, placing your first trade. This can feel like a momentous and slightly intimidating step, but understanding the mechanics behind it can demystify the process and give you confidence. As we proceed, our foundational rule is more important than ever. This chapter is for educational and informational purposes only. It is not financial advice. We are describing the functions of common order types, not recommending when or how to use them. The specific strategy you employ should be determined by your own research, your goals, and in consultation with a qualified financial professional. Before you even press the trade button, there's a key concept you'll see reflected in the app: the bid-ask spread. When you look up a stock or an ETF, you won't just see one price. You'll typically see two. The bid price is the highest price that a buyer in the market is currently willing to pay for that security. The ask price is the lowest price that a seller is willing to accept for that same security. The ask price will always be slightly higher than the bid price. The small difference between them is the bid-ask spread. As an individual investor, you will typically buy at the ask price and sell at the bid price. The spread is essentially a small, built-in transaction cost that goes to the market makers who facilitate the trade. For highly liquid, popular stocks and ETFs, this spread is often just a penny. For less traded securities, the spread might be wider. It's a small but important detail that explains why the price you buy at is slightly different from the price you could immediately sell at. With that understood, you're ready to enter an order. You'll navigate to the security you want to purchase and tap the trade or buy button. This will bring you to the order entry screen. Here, you'll need to make a few key decisions. The most important is choosing your order type. Let's discuss the two most common types. The first and most basic is the market order. When you place a market order, you are telling your broker to buy or sell a security immediately at the best available price in the current market. A market order prioritizes speed and certainty of execution. Your trade will almost always be completed, provided there are buyers and sellers available. However, a market order does not guarantee the exact price you will pay.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
In the seconds it takes for your order to be routed and executed, the price could fluctuate slightly. For a highly liquid security with a narrow spread, the price you get will likely be very close to the price you saw on your screen. But in a fast-moving, volatile market, the execution price could be noticeably different. This is known as slippage. The second common type is the limit order. A limit order gives you control over the price. When you place a buy limit order, you set a maximum price you are willing to pay per share. Your order will only execute if the security's ask price drops to your limit price or lower. Conversely, a sell limit order sets a minimum price you are willing to accept. Your order will only execute if the security's bid price rises to your limit price or higher. The advantage of a limit order is price control. You will never pay more or receive less than the price you specified. The trade-off is that there is no guarantee your order will be executed at all. If the security's price never reaches your limit price, your order will simply sit there, unfilled, until you either cancel it or it expires. Most brokers allow you to set an order as a day order, which expires at the end of the trading day, or good till canceled, GTC, which can remain active for weeks or months. Beyond these two primary types, some platforms offer more advanced orders for risk management. A stop order, also called a stop-loss order, is an instruction to buy or sell once a security reaches a certain price, known as the stop price. When the stop price is triggered, the stop order becomes a market order and is executed at the best available price. For example, a sell stop order is placed below the current market price and is often used with the intention of limiting a loss on a position. A stop limit order is a hybrid. It also has a stop price that triggers the order. However, once triggered, it becomes a limit order instead of a market order. This means it will only be executed at your specified limit price or better. This provides more price control than a standard stop order, but once again, risks the trade not being executed at all if the price moves too quickly past the limit price. On the order entry screen, after selecting your order type, you will specify the quantity, either in number of shares or, if fractional shares are supported, in a dollar amount. You'll then be taken to a confirmation screen. This is your final chance to review everything: the name of the security, the order type, the quantity, and the estimated cost. It is crucial to read this screen carefully before you submit your order. Once you submit, your order is sent to the market. Its status will change from pending to filled or executed once the trade is complete. Congratulations! You are now officially an investor. Your new position will appear in your portfolio, its value fluctuating with the market. In our next chapter, we will discuss what comes next: how to monitor your portfolio, understand your returns, and prepare for the long-term journey ahead. Hello and welcome back. In our last chapter, we demystified the process of placing your first trade, from understanding the bid-ask spread to choosing an order type. That first trade marks a significant transition, but it is just the beginning of your journey. Investing is not a one-time event. It's a long-term, ongoing process. This chapter is about what comes next: how to monitor your portfolio, understand its performance, and most importantly, manage your own expectations for the long road ahead. As we move forward, our core principle remains unchanged. This content is for educational and informational purposes only and does not constitute financial advice. How often you review your portfolio and what metrics you focus on are personal decisions that should align with your long-term strategy, developed in consultation with a qualified financial professional. After you've made one or more investments, your app's main screen will transform from a simple cash balance into a dynamic portfolio dashboard. This dashboard is your primary tool for monitoring your investments. While each app's design is different, they all present the same fundamental information. You will see your total portfolio value, which is the sum of all your investments plus any remaining cash. You'll also see the day's performance, how much the value has changed since the previous market close, shown in both a dollar amount and a percentage. Below this summary, you will typically see a list of your individual holdings. For each position, the app will show you the number of shares you own, the current market price, and the total value of that holding. Crucially, it will also display your total return for that specific investment. This figure shows you how much the investment has gained or lost since you purchased it. This brings us to two important terms you must understand: unrealized gains and realized gains. An unrealized gain is a paper profit. It means the current market value of your investment is higher than what you paid for it. It's a gain because it has increased in value, but it's unrealized because you haven't sold the investment yet. If the market value is lower than your purchase price, it is an unrealized loss. These values will fluctuate every second the market is open. A realized gain or loss occurs only when you sell an investment. If you sell a stock for more than you paid, you have realized a gain. If you sell it for less, you have realized a loss. This distinction is vital because in a taxable brokerage account, it is the act of realizing a gain that typically creates a taxable event. You do not owe taxes on unrealized gains, no matter how large they become. One of the most common questions new investors have is, how often should I check my portfolio? The answer is almost certainly less often than you think. The ability to see your portfolio's value change in real time is a modern technological marvel, but it can also be a significant psychological trap. Checking your investments daily, or even multiple times a day, can lead to emotional decision-making. You become hyper-focused on the short-term noise of the market rather than the long-term signal of growth. This can tempt you to overtrade, to sell during minor dips out of fear, or to chase stocks that are having a good day out of FOMO. For a long-term investor, reviewing your portfolio on a less frequent, scheduled basis, perhaps once a month or once a quarter, can be a much healthier approach. This allows you to step back and see the bigger picture, focusing on your long-term goals rather than reacting to daily volatility. When you do conduct these periodic check-ins, what should you be looking at? Beyond just the total return, consider your asset allocation. This is the mix of different asset classes in your portfolio. For example, you might have intended to have a portfolio of 80% stocks and 20% bonds. Over time, due to market movements, this balance can shift. If stocks have a great year, your allocation might drift to become 85% stocks and 15% bonds. This means your portfolio may now carry more risk than you originally intended. The process of periodically buying or selling assets to return your portfolio to its original target allocation is known as rebalancing. This is an important concept in portfolio management that helps to control risk. Some apps, particularly robo-advisors, may offer to do this for you automatically. For self-directed investors, it's a process to be aware of and to discuss with a financial advisor. Finally, remember to look beyond the app. Your investment app is just one piece of your complete financial picture. Your true progress should be measured against the financial goals you set for yourself at the very beginning of this journey. Is your savings rate on track? Are you consistently contributing to your accounts? These behaviors, which are entirely within your control, are often more important to your long-term success than the market's day-to-day performance. In our next chapter, we will discuss the topic of taxes, providing a high-level educational overview of how investments are taxed in the United States. Hello and welcome back. Throughout this series, we have covered the practical steps of choosing an app, opening an account, and managing your investments. Now we must address a topic that is intrinsically linked to every financial decision you make: taxes. The subject of taxes can seem intimidating, but having a foundational understanding is an essential part of being a responsible investor. This chapter comes with our most serious and critical disclaimer. The following content is for educational and informational purposes only. It is absolutely not tax advice or legal advice. The United States tax code is incredibly complex, subject to change, and your personal tax situation is unique. We are not certified public accountants, CPAs, or tax attorneys. You must consult with a qualified tax professional to understand your specific obligations and to make informed decisions. Misunderstanding tax law can lead to significant penalties. Our goal here is simply to introduce you to the key concepts so you can have a more informed conversation with your tax advisor. We will focus primarily on how investments are treated in a standard, taxable brokerage account. As we discussed briefly in a previous chapter, you do not pay taxes on investments simply because their value goes up. An unrealized gain is not a taxable event. A taxable event is typically triggered when you realize income, which usually happens in one of two ways: through the payment of dividends or by selling an investment for a profit. Let's start with profits from selling an investment. These are called capital gains. The amount of tax you might owe on a capital gain depends heavily on how long you own the investment before you sold it. This leads to the crucial distinction between short-term capital gains and long-term capital gains. A short-term capital gain is a profit from selling an asset that you have held for 1 year or less. In the eyes of the IRS, these gains are treated as ordinary income. This means they are taxed at the same rate as your regular income from a job, according to the standard federal income tax brackets. A long-term capital gain is a profit from selling an asset that you have held for more than 1 year. The tax code provides an incentive for long-term investing by taxing these gains at preferential rates, which are significantly lower than ordinary income tax rates. For many investors, the long-term capital gains tax rates are 0%, 15%, or 20%, depending on their overall taxable income. This difference in tax treatment is substantial and is a primary reason why a long-term, buy and hold approach is so often emphasized in investment strategy. The other common way to receive income from your investments is through dividends. A dividend is a distribution of a portion of a company's earnings to its shareholders. Just like capital gains, dividends have different tax treatments. Qualified dividends are those that meet certain IRS requirements, one of which is that you've held the underlying stock for a specific period of time. These dividends receive the same favorable tax treatment as long-term capital gains, being taxed at the 0%, 15%, or 20% rates. Many dividends from U.S. corporations are qualified. Non-qualified or ordinary dividends are those that do not meet the requirements. These are taxed at your regular ordinary income tax rates, just like short-term capital gains. At the end of the year, your brokerage firm will do the work of tracking all of this activity for you. Sometime in January or February of the following year, they will send you a series of tax forms. The most common one for a taxable brokerage account is the Consolidated Form 1099. This document will report your dividend income on Form 1099 DIV, and it will report the gross proceeds from all your sales, along with your cost basis, what you paid for the securities, to help you calculate your capital gains and losses, on Form 1099-B. You or your tax preparer will use this form to report your investment activity to the IRS. It is also important to remember that this discussion has focused on taxable brokerage accounts. The rules are very different for tax-advantaged retirement accounts like the IRAs we introduced in Chapter 6. In a traditional IRA, your investments grow tax-deferred, meaning you don't pay taxes on gains and dividends each year. You pay ordinary income tax on the money when you withdraw it in retirement. In a Roth IRA, your investments grow completely tax-free, and qualified withdrawals in retirement are also tax-free. For these accounts, your brokerage will send you a Form 5498, which reports your contributions for the year. Understanding these basic concepts, the difference between short-term and long-term gains, the tax treatment of dividends, and the existence of tax-advantaged accounts, is a crucial first step. It helps you appreciate that it's not just about what you earn, but what you keep after taxes. In our next chapter, we will discuss how to continue your educational journey, exploring resources for becoming a more informed and knowledgeable investor over the long term. Hello and welcome back. We are nearing the end of our foundational series on choosing and using an investment app. You have learned a 5-pillar framework for research, explored the investor's mindset, and understood the basic mechanics of investing. But your journey does not end here. In fact, it's just beginning. The world of finance is not static, it is constantly evolving. The most successful long-term investors are lifelong learners. This chapter is dedicated to guiding you toward reputable, high-quality resources for continuing your financial education. As always, we must state clearly that this is an educational guide, not an advisory service. The resources mentioned here are provided for informational purposes only. We are not endorsing any specific service, author, or publication. It is your responsibility to evaluate any source of information critically, and to consult with a qualified financial professional for personalized advice. Your first and most important port of call for unbiased, authoritative information should be the regulators themselves. The U.S. government and its designated regulatory bodies have a vested interest in protecting and educating investors. The SEC's Office of Investor Education and Advocacy runs a website called investor.gov. This site is a treasure trove of free, unbiased articles, tools, and investor alerts. It is designed specifically for individual investors and covers everything from the basics of different investment products to how to avoid common scams. Similarly, FINRA, the Financial Industry Regulatory Authority, has an extensive investor education section on its website, finra.org. They offer free tools like a retirement calculator and the broker check tool we've mentioned previously. They also publish Investor Insights, which are articles that break down complex financial topics and current trends into understandable language. Using these official sources as your baseline is a smart way to ensure you are getting factual, unconflicted information. Beyond the regulators, your next step is to cultivate a habit of reading. There are countless books on investing, but a select few are widely considered classics because their principles are timeless. While we will not recommend specific books, we can describe the types of books that have proven valuable to many. Look for books written by respected long-term investors that focus on mindset and strategy rather than hot stock tips. Books that explain the principles of value investing, the benefits of index fund investing, or the importance of behavioral finance can provide a solid philosophical foundation for your journey. Reading the biographies of successful investors can also offer profound insights into their discipline, patience, and decision-making processes over many decades. In today's fast-paced world, podcasts have become an incredibly popular way to learn. There is a vast universe of financial podcasts, but quality can vary dramatically. Seek out podcasts that focus on education rather than entertainment or speculation. Look for hosts who are credentialed professionals or experienced financial journalists. A good educational podcast will often feature interviews with experts, break down complex economic news, and discuss timeless financial principles in an accessible format. Be cautious of podcasts that heavily promote specific products or promise unrealistic returns. The goal is to find sources that make you a more informed thinker, not a more impulsive trader. Staying informed about current events is also important, but it requires a careful approach. Consuming a constant stream of breaking financial news can lead to the kind of short-term, emotional decision-making we've cautioned against. It's often more beneficial to seek out reputable, long-standing financial news organizations that provide deep analysis rather than minute-by-minute market updates. Publications like the Wall Street Journal, the Financial Times, Bloomberg, and Reuters have a long history of in-depth financial journalism. Many of these require a subscription, but they can be invaluable for understanding the broader economic trends that shape the markets. Finally, don't underestimate the educational resources provided by your own brokerage app. As we discussed in Chapter 5, many of the top-tier platforms invest heavily in creating high-quality educational content for their clients. Explore the Learn or Education section of your app. You may find webinars, tutorials, and well-researched articles that are directly relevant to the tools and features you are using. The key to all of this is to build a habit. You don't need to become a financial expert overnight. Dedicate a small amount of time each week, perhaps an hour on a Sunday morning, to your financial education. Read a chapter of a book. Listen to a podcast during your commute. Read one in-depth article about the economy. Over months and years, this consistent, small investment in your own knowledge will compound, just like your financial investments. It will make you a more confident, more resilient, and more discerning investor, capable of navigating your financial future with wisdom and prudence. In our final chapter, we will bring everything together, summarizing our key takeaways and offering some concluding thoughts on your path forward. Hello, and welcome back for the final chapter of our comprehensive guide. We have traveled a great distance together on this educational journey. We began with the overwhelming challenge of choosing from a sea of investment apps and methodically built a framework to bring clarity to that choice. We've explored the inner workings of the market, the psychology of the investor, and the practical steps of getting started. Today, in our concluding chapter, we will synthesize the most important principles from our series and look toward your future as an informed, empowered, and responsible investor. Before we summarize, we will state our most important message one last time. This series has been created for educational and informational purposes only. It is not and has never been a substitute for professional, personalized advice. The worlds of finance, tax, and law are complex and deeply personal. We are not financial advisors, tax professionals, or attorneys. Your financial path is your own, and we strongly, unequivocally, urge you to navigate it with the guidance of qualified, licensed professionals who know you and your specific situation. Our journey began with the creation of a 5-pillar framework for research, a mental model to help you evaluate any investment platform on its own merits. Let's revisit those pillars one last time, as they are the foundation of your due diligence. Pillar 1 was cost. We learned to look beyond the commission-free marketing to understand the true costs, from expense ratios and options fees to the less visible costs associated with business models like payment for order flow. Pillar 2 was security and regulation. We established the non-negotiable need for SIPC insurance to protect against firm failure, and for FINRA and SEC oversight. We also highlighted the importance of digital safeguards like two-factor authentication. Pillar 3 was investment options. We surveyed the landscape of assets, from individual stocks and fractional shares to diversified vehicles like ETFs and mutual funds, emphasizing the need to align the app's offerings with your own strategy. Pillar 4 was user experience and education. We recognized that a well-designed, intuitive app that also provides high-quality educational resources can be a powerful partner in your long-term growth. And Pillar 5 was account types and features. We saw the importance of ensuring a platform can support your long-term goals, whether through a standard brokerage account or tax-advantaged retirement accounts like an IRA, and offers features like automatic investing to build good habits. This framework is your shield against hype and your tool for making a rational, informed choice. But we quickly learned that the tool you choose is only half the story. The other half is the mindset of the person using it. We confronted the powerful emotions of fear and greed, the paralysis of overwhelm, and the common behavioral biases that can lead investors astray. The key takeaway was to anchor yourself in your long-term goals. Your why for investing is what will allow you to weather the inevitable storms of market volatility. It is what will give you the discipline to stay the course when fear tells you to sell, and the prudence to be cautious when greed tells you to chase unrealistic returns. From there, we walk through the practical steps. Opening and funding your account, understanding the mechanics of a market or limit order, and the crucial distinction between unrealized and realized gains. We touched on the importance of understanding the tax implications of your decisions, and, most recently, on the value of becoming a lifelong learner. So, where do you go from here? The path forward is one of discipline, patience, and perspective. Your success as an investor will likely not be determined by picking the one perfect stock, or by timing the market perfectly. It will be determined by your behavior over a very long time. It will be determined by your savings rate, your ability to consistently put money aside to invest. It will be determined by your patience, your ability to let the power of compound growth work its quiet magic over years and decades. And it will be determined by your perspective, your ability to focus on your own personal goals and not get distracted by the daily noise of the financial media. The app on your phone is simply a gateway. It is a powerful tool that gives you access to the global economy in a way that was unimaginable a generation ago. But it is you who must bring the strategy, the discipline, and the long-term vision. We hope this series has served its purpose. We hope it has demystified a process that can seem complex and intimidating. We hope it has given you a clear, logical framework for making decisions, and that it has empowered you to take the next steps in your financial journey with confidence and a deep sense of responsibility. The goal was never to give you the answers, but to help you learn how to ask the right questions. Your financial future is in your hands. Build it with knowledge, protect it with diligence, and nurture it with patience.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.